Hycroft mining has been trending in popularity recently, and many people are wondering if they should be buying more, selling what they have, or simply standing on the side and wait for a better timing. As the market is still very volatile at the moment, we should always be mindful about which stocks to pick and what would be the exposure and the timing of our positions. Over the past few days, the price actions of Hymc has brought the stock to $2.26 before stabilizing around $2. The short-term price trend of Hycroft mining has been bullish because recently the market showed a lot of interest to the potential for the stock to reach new highs, and that interest has managed to stay and to hold its ground against the possible mass sell-offs from existing shareholders before the takeoff. I think that the stock is going to have even greater surges in the future as the volume of Hymc remains strong, and the stock seems to be regrouping for more momentum in the weeks to come. When we look at the long-term price trend of Hycroft mining, it has been bullish as well. The stock has been making new highs left and right, and there is no reason currently to believe that it shouldn't continue this momentum as we go forward. In a general environment with significant selling pressure, I think that Hymc can bring some much more needed change of ambience and momentum in our portfolios. Now, let's take a look at the technicals of the stock. The trading volume of Hycroft mining has recently been 16 million shares versus an average volume of 89 million shares. Over the previous 52-week period, its price fluctuated between 28 cents and $4.37. The market cap of Hycroft mining is currently at $429 million compared to an enterprise value of $196 million. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. The enterprise value is the combined value of the company's assets minus the debts. If the company has a lot of debts or a negative image amongst market participants, the asset's value may be impaired. With that being said, at the end of the day, it remains an estimation of the market every time it publishes its financial statements, so it's less reactive than the market cap and often more lenient for many other companies. One key element to note regarding the enterprise value is that for many growth-type companies, one of the most significant assets they own is the goodwill. Goodwill is an expectation of the market that a company can generate more profit or grow faster, because it might have a better management team, a stronger brand recognition, and a bigger online following. It is what makes a company unique compared to its competitors. In other words, goodwill is not a tangible asset that companies may use. It is often, however, the reason why some companies are perceived to be trading at a discount, because the market cap is lower than the enterprise value, and the enterprise value is less reactive than the market cap in volatile situations. If the company goes to liquidation, the goodwill would be gone, and the bondholders and the shareholders will be left sharing amongst each other whatever that is not depreciated, which is far less compared to the number on the balance sheet. When we compare the current price to its historical price fluctuations, the stock is 81% higher than the 1-month low, 608% higher than the 12-week low, and 608% higher than the 52-week low. On the options market, which often gives us a hint about the market sentiment on where the stock price is likely going to go next, the implied volatility is 81% versus a historical volatility of 608%. The put-call volume ratio is currently at 0.33. It is normal for many stocks to have a higher put option volume than what they truly deserve, as many institutional investors systematically hedge their long positions by buying put options. The most recent volume of options traded has been 20,000 contracts a day, compared to the 30-day average of 43,000. In terms of open interest, the most recent volume of open interest has been 303,000 contracts versus the 30-day average of 192,000 contracts. In terms of its shareholder structure, institutional shareholders own about 18% of the current float. The biggest shareholders include Nomura, Whitebox, and Vanguard. It's relevant to understand the shareholder composition of a company as this helps us to determine if the stock is a long-term investment or should be simply viewed as a trade opportunity. If the stock is mainly held by retail traders, this is a sign that the stock lacks the depth to justify long-term trust from shareholders. Typically, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. There's obviously a lot of exceptions to this, as many great companies are also mostly held by retail investors, but that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes when there are significant short interest in the total volume, this is a sign that something more organized may be going on, like what has been going on with Ethereum, GameStop, AMC, and so on. The current short interest is about 7% of the total float and 53% of it coming out of the dark pools. Usually, if the short interest is about 15% of the total volume and a significant chunk of the short volume coming out of the dark pools, this may be a red flag that institutional positions have taken a position against it, and there would be potentials for a short squeeze. My position, given all my analysis, is to buy Hycroft mining because it is a matter of time, in my opinion, before the current pause is going to end and the volatility to kick in once again. The stock may be too high to commit all your capital, but I would say that now is a decent entry point considering the context we're in. Of course, always be mindful that the volatility may be beneficial or drag it downward. So always structure your trade having this thought in your mind. I would recommend to commit between 1 to 3% of your portfolio into Hymc. And I would also recommend to split the allocation in batches of 10 to 20% at a time so that you may purchase more afterwards if it retraces. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks with the expectation that they will be loaned to businesses. Normally, that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up, or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, Capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.